Key market participants and their role in the stock market. Welcome to today's presentation on the key market participants and their roles in the stock market. The stock market is a dynamic environment with numerous players, each contributing to its overall efficiency, liquidity, and stability. These participants, ranging from individual retail investors to large institutions, intermediaries, and regulatory bodies, work together to ensure the smooth functioning of the market. Understanding their roles is essential to truly comprehend how the market operates. Understanding these elements is critical to making informed and strategic investment decisions. Retail investors. First, we have retail investors. These are individuals who buy and sell stocks for personal investment purposes, typically using online brokerage platforms. Unlike institutional investors, they invest smaller amounts of capital and make decisions based on personal financial goals. These goals can range from building wealth and planning for retirement to generating passive income. Retail investors often adopt various strategies, including long-term investing or short-term trading, such as day trading or swing trading. They are heavily influenced by market news, trends, and even social media platforms. Examples include individuals managing portfolios using apps like Robinhood, E-Trade, and Fidelity. Beginner traders hoping to grow their savings through the stock market. Institutional investors. Next, we have institutional investors. These include large organizations such as pension funds, hedge funds, and insurance companies that manage substantial amounts of money on behalf of their clients. With access to sophisticated tools and large financial resources, they can execute trades in high volumes, significantly influencing stock prices. Their investment strategies are often rooted in quantitative analysis, algorithmic trading, and diversification. Although they typically hold long-term positions, they may also engage in short-term trading for portfolio optimization. Prominent examples of institutional investors. Pension funds like the California Public Employees Retirement System, known as CalPERS. Hedge funds such as Bridgewater Associates and BlackRock. Market makers play a crucial role in ensuring the smooth functioning of the stock market by providing liquidity. These financial institutions or brokerage firms continuously buy and sell securities, ensuring that traders can execute orders quickly. Market makers provide two-sided quotes, meaning both bid and ask prices, and they profit from the bid-ask spread. By absorbing excess buying or selling pressure, they help reduce market volatility. To maintain fair market practices, market makers must comply with regulatory requirements. Notable market makers include investment banks such as Goldman Sachs and JP Morgan, electronic trading firms like Citadel Securities and Virtu Financial, brokers and brokerage firms. Brokers act as intermediaries between buyers and sellers, executing trades on behalf of investors. Brokerage firms provide platforms that allow retail and institutional investors to access financial markets. These firms offer services that may include research reports, trading advice, and even full portfolio management. There are two main types of brokers: full-service brokers, who provide advisory and financial planning, and discount brokers who offer self-service trading platforms. Some also offer margin accounts, enabling investors to leverage their positions. Examples include online platforms like Charles Schwab and Interactive Brokers. Traditional firms such as Morgan Stanley and Merrill Lynch. Regulatory bodies ensure that the stock market operates transparently, fairly, and in a way that protects investors. These government and independent agencies enforce trading laws and monitor market participants to prevent fraudulent activities such as insider trading and market manipulation. Regulators also ensure that public companies provide accurate financial disclosures, promoting investor confidence and maintaining market integrity. Key regulatory bodies include, in the U.S., the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. In the UK, the Financial Conduct Authority, FCA. In the EU, the European Securities and Markets Authority, ESMA. In Asia, the Securities and Exchange Board of India, SEBI, and the Japan Financial Services Agency, JFSA. Stock exchanges are organized marketplaces where securities are traded in a regulated and transparent environment. They facilitate price discovery based on supply and demand, set listing requirements for companies, and offer various types of trading mechanisms, such as auctions and electronic matching. Exchanges generate revenue through listing fees, transaction charges, and data services. Major stock exchanges include, in the US, the New York Stock Exchange, NYSE, and NASDAQ. In Europe, the London Stock Exchange, LSE, and Euronext. In Asia, the Tokyo Stock Exchange, TSE, and the Shanghai Stock Exchange, SSE. Investment banks help companies raise capital through initial public offerings, mergers and acquisitions, and other financial services. They underwrite new stock issuances and advise corporations on financial strategies, valuations, and restructuring. Investment banks also engage in proprietary trading, asset management, and economic research, providing valuable insights to investors. Examples of leading investment banks include Goldman Sachs, Morgan Stanley, and Bank of America, Merrill Lynch. Clearinghouses ensure the smooth and secure transfer of securities and funds between buyers and sellers. By acting as intermediaries, they reduce counterparty risk and ensure that trades are executed and contracts fulfilled. Clearinghouses also manage collateral and margin requirements, helping to enhance market stability and reduce systematic risks. Examples of clearinghouses include, in the U.S., the Depository Trust and Clearing Corporation, DTCC. In Europe, the London Clearing House, LCH. Analysts and research firms play a critical role by providing insights and recommendations based on financial data and market trends. They conduct fundamental and technical analysis to issue reports on earnings forecasts, stock ratings, and industry trends. These reports influence investor sentiment and, in turn, market movements. Independent research firms provide unbiased insights, while sell-side analysts work for brokerage firms, offering client-specific recommendations. Prominent examples of research firms include Morningstar, Bloomberg, and Moody's. Speculators and traders engage in short-term buying and selling, aiming to profit from market fluctuations and volatility. They utilize various strategies such as day trading, swing trading, and algorithmic trading. High-frequency trading, or HFT, is often used to execute trades at lightning-fast speeds. By accepting high levels of risk, speculators contribute to market liquidity and price efficiency. Examples include individual day traders and proprietary trading firms. In conclusion, the stock market operates as a complex ecosystem with diverse participants, each fulfilling crucial roles that contribute to market efficiency, liquidity, and stability. Understanding these key players is essential for navigating the market effectively and making informed investment or trading decisions.